Gold just did something that should not make sense on the surface. Since late February 2026, the world has been watching a real war unfold in the Middle East, and gold fell instead of rising. It dropped from an all-time high near 5,600 an ounce in late January down to around $4.00 in some weeks, a decline of roughly a quarter of its value while a shooting war between the US, Israel, and Iran was actively happening. If you learned anywhere that gold is the asset that goes up when the world gets scary, this should stop you in your tracks. And at the same time, the People's Bank of China kept buying, not selling. Buying month after month through the middle of the drop. That combination is what I want to walk through with you because it tells you something real about how money moves today, and it is worth 15 minutes of your attention. Let me start with what actually happened, in order, because the sequence matters more than the headline number. Gold spent most of 2025 and early 2026 climbing. It hit its record high around January 28, 2026, close to 5,600 an ounce. That climb had been building for months, driven by central banks buying gold at a pace not seen in decades, worries about the US dollar, and general nervousness about the economy. Then, in late February, the US and Israel launched military strikes against Iran. Iran responded by disrupting shipping through the Strait of Hormuz, one of the most important oil routes on the planet. In the first days of the conflict, gold did exactly what the textbook says it should do. It jumped, briefly touching over 5,300 an ounce as investors reached for the classic safe haven trade. And then the textbook stopped working. Instead of continuing higher as the war dragged on, gold turned and fell and kept falling for weeks. By March, it was trading in a range around 4,300 to 4,600. By some weeks in the following months, it had dropped toward $4,000, which multiple financial outlets described as roughly a 26 to 28% correction from the January peak. This happened while the war was still going on, not after it ended, while the shooting was still happening. That is the part that confuses people, and it is the part that actually explains what is going on underneath. Here is the mechanism in plain terms. When Iran started interfering with shipping in the Strait of Hormuz, oil prices shot up, at points trading above $105 to $110 a barrel. Higher oil prices push up inflation because energy costs flow into the price of almost everything else. In the US, inflation climbed to its highest level in about 3 years. That put the Federal Reserve in a bind. Before the war, there had been real hope that the Fed would cut interest rates. After the war started driving inflation higher, that hope collapsed. Markets began pricing in the chance that the Fed would hold rates steady or even raise them instead of cutting. Gold does not pay interest, it just sits there. So when interest rates on safer assets like US Treasury bonds go up, holding gold instead of those bonds becomes more expensive in terms of what you give up. That is called opportunity cost, and it is one of the most reliable forces that pushes gold down even during a crisis, if the crisis is also pushing inflation and interest rates up at the same time. On top of that, there was a more mechanical driver. As stocks and bonds took losses elsewhere during the war-driven turmoil, some institutional investors needed cash to cover those losses, a process often tied to margin calls. Gold, being one of the few assets that had actually gone up in value over the prior year, became a convenient thing to sell to raise that cash. So paradoxically, gold's own success going into the war became a reason it got sold once the war hit, because it was one of the few profitable positions people could liquidate. A stronger US dollar during the crisis added another layer of pressure, since gold is priced in dollars, and a stronger dollar generally makes gold more expensive for buyers using other currencies, which tends to weigh on demand. Now, here is the second half of the story, the part with China. While all of this was happening, official reporting showed the People's Bank of China continuing to add to its gold reserves, extending a buying streak that by some counts had run 18 consecutive months, including added tonnage in the same window that the war was pushing prices down. China was not alone. According to the World Gold Council, central banks globally bought an estimated 244 tons of gold in the first quarter of 2026 alone, which came in above both the prior quarter and the 5-year average. Poland, Kazakhstan, and Brazil had already been standout buyers in the prior year. And in a survey the World Gold Council ran of dozens of central banks in 2026, nearly 90% expected total central bank gold holdings to rise over the next 12 months, and a record share expected their own country's reserves to grow. At the same time, it would be dishonest to tell you every central bank was buying. Some emerging market countries were doing the opposite. Turkey sold a large amount of gold, reportedly well over 100 tons in a single month, to defend its currency, the lira, which was weakening sharply during the war. Russia sold a smaller amount tied directly to financing war costs. Analysts who track this closely have generally described these sales as forced, short-term moves by countries under acute financial pressure, not a change of heart about gold's long-term role. The countries selling were doing it because they had to raise cash fast. The countries like China that kept buying were following a much longer, slower plan, one that does not really care what gold's price does over a few weeks or months. That difference is the whole story, and it is worth sitting with for a second. A country like China is not trying to time the market the way a day trader might. Central banks that hold gold as a strategic reserve are generally thinking in years and decades, not weeks. Their reasoning tends to run like this. Gold is not a promise from any government. It is not someone else's liability. A U.S. Treasury bond is a promise from the U.S. government to pay you back. Gold does not depend on any country's promise at all. As more of the world becomes uneasy about depending too heavily on the US dollar for reserves, gold becomes attractive precisely because it sits outside that system. According to the same 2026 World Gold Council survey, nearly 3/4 of central banks said they expect to moderately or significantly reduce their US dollar holdings over the next 5 years. That is a slow-moving structural shift, and it does not reverse because of a 10-week war. It's worth putting this in a bit of historical context, because this is not the first time gold has behaved in a way that confused people watching a war unfold. After the Bretton Woods system broke down in 1971, when the US stopped directly linking the dollar to gold, gold went through years of extreme volatility that had far more to do with U.S. monetary policy than with any single conflict. During the 2008 financial crisis, gold actually dropped sharply in the initial panic as investors sold everything, including gold, to raise cash, before rallying hard in the years that followed as central banks cut rates and printed money. That 2008 pattern, sell gold first for liquidity, then buy gold later, once the dust settles and the money printing begins, looks a lot like what some analysts think could still play out from 2026's war, if and when it eventually cools down. So what does this actually mean for someone watching their own money rather than a trading desk? A few things seem fair to say, without pretending anyone can predict exactly what happens next. First, a falling gold price during a war is not automatically proof that gold has stopped being a safe haven. What it usually means is that, right now, a different force, in this case inflation and interest rate expectations, is temporarily stronger than the fear-driven demand for gold. Second, when long-term patient buyers like several central banks keep accumulating gold through a price drop, that is generally read as a signal about how those institutions view gold's role over years. not as a bet on the next few weeks. Third, and this cuts the other way, short-term corrections in a genuine long-term uptrend can be sharp, uncomfortable, and long enough to shake out people who bought near the top, expecting a straight line up. A 26 to 28% pullback is not small. If you had bought gold near its January peak, this would have hurt. I want to be straightforward here rather than dramatic. Nobody, including me, knows exactly when this particular pattern reverses, or whether it reverses at all in the way the 2008 comparison suggests it might. Interest rates, oil prices, and the length of this specific conflict all still matter, and all remain genuinely uncertain. What is verifiable because it comes from public World Gold Council data and mainstream financial reporting rather than any claimed inside knowledge. Is that a meaningful gap opened up in 2026 between what gold's price was doing week to week and what several long-horizon central bank buyers were actually doing with their reserves? That gap is real, it is documented, and it is worth understanding on its own terms rather than through a single gold always goes up in a crisis assumption, which this war has now clearly complicated. If you want to look into this yourself, rather than take my word for any of it, the World Gold Council publishes its quarterly gold demand data publicly, and it is the primary source most of the reporting above is built on. I'd rather point you there than tell you what to do with your own money. What is the one number from this video that surprised you most? Write it below, just the number.